Hello and welcome to Quant Matters, where we talk about the quantitative approach to investing and finance. In this episode, we'll talk about the practice of predicting financial markets, why investors try to do it, some of the ways prediction works, and some of the problems that come with it. An introduction to the topic, if you will. If you want the code behind the dashboards or a written version of the material, there's a Patreon link below. Financial markets operate through a risk and reward dynamic we previously covered, so at a surface level, it may seem like you do not need to predict anything to participate in them. You simply need an investment thesis and an understanding of your risk tolerance. But any investment thesis contains an expectation about the future. Even passive investing assumes that productive assets will appreciate over time and compensate investors for risk. In other words, investing already contains prediction, whether explicit or implicit. When we talk about predicting markets more deliberately, we mean using past and current information to anticipate future asset prices or market behavior. The objective is to position yourself in a way that benefits from your expectation. If you expect an asset to rise in value, you buy today. If you expect it to fall, you may sell, stay in cash, or avoid it altogether. You can also make predictions about relationships between assets and adjust the broader portfolio accordingly. Successfully predicting market behavior can substantially improve returns. Emphasis on successfully, because prediction is inherently unreliable, and to understand why, we first need to understand what predictions actually are. Every prediction, whether it comes from a quant model, a chart pattern, or a portfolio manager's intuition, is ultimately a probability statement. It is never, "this will happen." It is, "this outcome is more likely given the information I currently have." This is where Bayesian thinking becomes useful. The core idea is simple. You begin with a prior belief, you observe new evidence, and you update that belief accordingly. The updated belief then becomes a new prior the next time information arrives. In finance, your prior might be something like, "this stock tends to perform well in the fourth quarter because of seasonal demand." Then earnings data, interest rate changes, or competitor announcements arrive, and you revise that belief up or down. A good predictor is not someone who is always right, but usually someone who updates well. Most bad predictions do not fail because the original idea was completely irrational. They fail because the person making the prediction stopped updating. They become attached to the thesis and ignore the evidence working against it. Bayesian thinking is really just a formal way of staying honest. Broadly speaking, market probabilities come from two places: historical frequency and subjective judgment. Historical frequency is based on repetition. If an asset has risen in January 70% of the time over the last 30 years, you might assign a rough 70% probability of it rising this January as well. Most quantitative models operate on this logic. You study historical data, measure how often a signal worked, and use that frequency as a probability estimate going forward. The second source is subjective judgment. A macro analyst estimating the probability of a future interest rate cut is usually not working from a clean historical frequency. They are synthesizing economic information into a reasoned estimate. This is where judgment, experience, and narrative enter the process. Both approaches have limitations. Historical frequency assumes the future will resemble the past, which is a fragile assumption in markets because markets constantly evolve. Once a profitable pattern becomes widely known, it often weakens or disappears. Subjective judgment has its own problems. Human beings are vulnerable to overconfidence, confirmation bias, anchoring, and a narrative fallacy. These distortions can quietly corrupt a prediction without the person realizing it. The practical takeaway is that market probabilities should be held loosely. They are best current estimates, not facts. Projection is one of the simplest forms of prediction. Rather than asking what forces will move the asset, projection asks, if current trends continue, where does this asset end up? Trend lines, moving average, and regression models all belong to this family. You are not necessarily explaining why prices move. You are extending an existing pattern into the future. Projection is useful because it is systematic and reproducible. Two analysts using the same data and the same method should arrive at roughly the same result. It also forces you to make your assumptions explicit. A linear projection assumes a constant rate of change. An exponential projection assumes accelerating growth, and so on. The weakness of projection is that it struggles with structural breaks, moments where the underlying dynamics of the market suddenly change. A model trained on pre-2020 volatility data, for example, would have struggled during the market chaos of March 2020. Not necessarily because the mathematics were wrong, but because the environment changed in ways the model was not built to handle. This is something called model risk, the risk that your assumptions stop matching reality. We'll get into specific projection techniques in future episodes. For now, this is just the conceptual foundation. Predicting markets is really an umbrella term covering several very different approaches. They differ in the data they use, the assumptions they made, and the time horizons they operate on. Technical analysis uses price and volume data to identify patterns and trends. The underlying assumption is that market behavior repeats because human behavior repeats. This is the world of trend lines, candlestick patterns, and momentum indicators. Fundamental analysis looks at the economics behind an asset, earnings, cash flows, balance sheets, interest rates, and broader macroeconomic conditions. The idea is that price eventually converges towards intrinsic value. Quantitative approaches attempt to extract predictive relationships directly from data using statistics, factor models, time series analysis, or machine learning methods. This is the primary territory of this series. Sentiment and alternative data approaches use information outside traditional market data. Social media activity, satellite imagery, web traffic, and credit card transaction flows are all examples. The idea is that unconventional data may contain information the market has not fully incorporated yet. None of these approaches is universally superior. They operate under different assumptions and work over different time horizons. Many practitioners combine several of them. What matters is understanding what each approach is actually claiming and what kind of evidence would support or weaken that claim. Markets are difficult to predict. Most active managers underperform passive benchmarks over long periods of time. Many predictive signals degrade once they become widely known. Statistical relationships that look convincing in backtests often weaken or disappear in live trading. This is not a reason to abandon prediction, but it is a reason to approach it with humility. There is also the problem of what exactly you are predicting. Predicting direction is different from predicting magnitude. You might correctly predict that an asset will rise, but underestimate how volatile the move will be, or overestimate how large the gain will become. Depending on your positioning, that difference can determine whether the trade succeeds or fails. Prediction is rarely binary. In practice, profitable prediction usually requires execution rules, risk management, and position sizing. And finally, the goal of prediction is not to be right on every call. That is impossible. The goal is to be right often enough and by enough of a margin that your decisions add value over time after transaction costs, bad periods, and inevitable model failures are accounted for. That is a much more realistic goal than predicting the market. Prediction in finance is ultimately an attempt to make better decisions under uncertainty. Not certainty, not clairvoyance or divination, just better positioning based on incomplete information. Sometimes that positioning comes from statistics, sometimes from economic reasoning, sometimes from behavioral patterns, and often from a combination of all the three. In future episodes, we'll start looking at some of the actual tools used to build these predictions, from trend analysis and factor models to volatility, macro indicators, and quantitative signals. If you find this content useful and want to support the channel, the Patreon is linked below. Thanks for watching.